All right, welcome guys to Tales from the Lockbox. I'm your host, Josh Benoliel, VP of Sales here at Property.ca and home of Condos.ca and Mr. Loft.ca. And today we are joined with Moe and Carlton from White Gold Financial. They are a preferred vendor of us here at Property.ca. They are an accounting firm that specializes in tax planning, in doing your taxes, everything associated with that. So welcome guys. Why don't you guys tell us a little bit about who you are, who White Gold is, and we'll go from there. Lead up one of you guys.
Carlton? Okay, so White Gold Financial is an accounting and tax firm, like you pointed out. So the list of services we provide not only just go with accounting and taxes, we also specialize with corporations, like advising clients about how to do real estate investments in corporations, etc., and also look onto your tax perspective on a long-term scale. So that's our specialty. We're not just worried about you today and tomorrow's issue. We're also going to think about your 5, 10 years, lifetime of our succession plan. We can give advice like help how we can save on the tax portion of it on that side.
Great. Okay. And Mo, why don't you tell us a little bit about how White Gold started, where it came from, what kind of the whole story behind it?
So White Gold is owned by my brother Jacob Abecassis, and how it started. It's funny you should ask that. I remember now, maybe going back, I want to say something like 30 years or so. It started in flea markets. I happened to be working at Canon at the time, and I remember getting my brother this Canon printer so that he can print tax returns right there in the flea market, starting with the personal taxes. So he started the business and has been running it ever since. I joined about 6 months ago in an operations and growth capacity. To go back to what Carlton was saying, there's this great video out there by Simon Sinek. It's called Start With Why. It talks about the golden circle. It's a construct you may be familiar with. But I've been asking myself, what is the why of White Gold? And I think the thing that differentiates us from perhaps other accounting providers, tax providers, is that we're not only looking at the situation through the lens of tax and short term, like Carlton said, we're looking at it through the lens of wealth generation. And when you start to look at something through that lens, when you start to look at your financial situation with taxes being the biggest dollar amount you're going to spend in your life, right? And you don't just look at it as an expense, but you look at it as wealth, it really changes the dynamic. It changes the types of conversations that you're having with people. So that's kind of the exciting part about what White Gold is, and what I would suggest is the primary element of the why we exist.
Cool.
Yeah.
And I think that's important for people to understand. I know, especially for real estate agents out there, you get into real estate, you start off, you're like a fish out of water, you don't know what's going on. When you come to work at a brokerage like ours, we start feeding you with leads, you start to have some success. Average in our first year agent, I would say they make somewhere between $60,000 to $75,000. By the time you do your taxes, you still might be getting a return at the end of the year if you're in that tax bracket, given that. But what starts to happen is in the second and the third year, especially for people who are putting in the work, one of the people who I mentioned earlier, and now you break that 100K, 150K threshold, all of a sudden, you come to your accountant at the end of the year and they're like, okay, well, it's time for you to pay us $45,000 right now. That sticker shock is a massive situation. And I firsthand, running brokerages now in this company now for 6 years, it's been almost 7. And I've seen this time and time again. I've seen it happen to myself over time, and now I've seen it happen to agent after agent, one of which I was literally talking to last week. They probably called you about it. And I think working with accountants who are analyzing not to just save you money on your taxes or efficiently do your taxes better, but actually are working with you to strategically plan how your wealth is being divided, what you're doing with it, where is it going, how is it funneling through, setting it up as an organization rather than just an individual paying taxes, makes the biggest difference in the long run. And I want to get into that a little bit. So my first kind of question for you guys coming out here, this talk about PRECs. So let's talk about PRECs a little bit, a personal real estate corporation. Couple right off the top questions that I think agents need to know is, what is a PREC? Who should be getting a PREC, and when should you be getting it, and when does it make sense to get it? And then we can go from some questions from there. So why don't you take it away, Carlton?
So the Personal Real Estate Corporation, it is a corporation for real estate agents. So like how you have corporations that, let's say, for doctors or for construction, for renovation, etc. So it's the same principle, except corporation is an entity of its own. And now what's the benefit of a corporation is there's the perpetual existence. A corporation is forever. That's why you look at like Hudson Bay as an example. Since around the late 1600s till now to this date, it's one of the oldest companies in Canada. So the company exists. The only thing is just the owners just change. So now with that perspective, because it's an entity of its own, because the business is conducted and concluded in the corporation itself, it's corporation income. They have to pay taxes, like how you pay taxes, I gotta pay taxes, Mo's gotta do the same thing. Now we got our individual taxes, the corporation will have corporate taxes. And if you're looking from a tax benefit perspective, is the advantage of paying at 12.2%, which at federal and Ontario, you're paying at that tax rate. And now what's the beauty is, real estate agents have been fighting this for about 27 years to get the ability to get a corporation, because on average, your commissions may be about 150 to 300, upwards to $500,000 plus. The principle with the personal taxes is the more you make, well, the more you pay on your personal taxes. Like how you said, first year you did 70, next year you got 150, and you're like, whoa, I'm paying more. It demotivates some agents to realize, maybe I should not do 150 for tax planning purposes. Right. I'm just going to stick at 100. So the ability now to get the corporation, it just kind of like we have let the cage free. Now the agents can go wild, and they can keep going on with the hustle and have the what we call commissions or the income through the corporation, pay you 12% and structure it, of course, so you have advantages to it. Now, a good question that you asked is when is the right time for an agent to incorporate a PREC?
Because there's a cost associated with it, right? You're paying double the accounting fees now. The corporation needs accounting done. You need to keep track of two different sets of records, your personal records plus your corporation records. So it complicates things a little bit. So again, when should an agent in their journey of growth and success really start to consider, when does it make sense for somebody to say, hey, I should get a PREC now?
Yeah. So that's a good question. So we've been doing corporations for a long time. White Gold's been a firm since 1990. So we've found out that the right threshold for agents or for anyone else, when is the right time to move your business into a corporation? We've always strongly recommended if you're making anywhere between 60 to 70,000 gross in income, that's the best time to incorporate. Of course, there's going to be room for growth because you're not going to be making 70 a year. You may do 100. If you fall back to 70, still you got that safety net. You're only paying at 12%. So 60 to 70 is what we recommend. A lot of agents would have heard this from other sources or they might have read that 200 is the threshold. We don't like suggest that. Why? Because yes, at 200,000 or 220 and above, you pay 53.3%. That's the highest tax rate in Canada. So anything up to 200,000, you're still paying around up to the 48% mark or 50. So you're still paying more taxes. So 60 to 70 is a highly recommended number that we say to get a corporation. And through the corporation, you can set up a payroll or dividends where you're paying yourself. So yes, you gotta have to pay personal tax too. But structure it. You have the ability to dictate how much you want to pay on your personal. You're not taking a lot.
So let's pause you right there because you live in the accounting world. Yeah. You talk an accountant talk. It's something I have to argue with White Gold all the time. To slow down and just let's break it down for us regular folk, us real estate agents. We're not as sophisticated as you accountants. So I make 70 grand a year. Yeah. Instead of taking that money personally to myself and paying personal income tax, I now go ahead, I pay you guys $1,700, $1,800. You set up this corporation, whatever the number is, I think it's in that range. And now, 800, so we get a special rate 800. Anyone listening to the podcast can also get the White Gold discount. Use code Tales from the Lockbox to get that code. So you set up this corporation, and now all of a sudden the brokerage is now paying this money into this PREC, this entity. Company. Okay, so now can I go and pay for my son's bagel tomorrow morning from that company?
So I wouldn't go pay for your son's bagel tomorrow.
I'm giving some examples. Yeah, so the answer is no.
No. The answer is different.
Different. Okay, that wasn't a good one. You're on. Can I go buy a brand new pair of jeans at Yorkdale Mall for myself tomorrow in that corporation?
No. So the most important thing is now the Income Tax Act. It states that if for any business deductions that is being used against an income, has to be reasonable in nature. That's the key word, reasonable.
Of course, and we're going to get there. We're going to ask a couple more examples so people can start to get their head around this if
Yeah,
you've never
but
dealt
stay
with
on
this.
that point for a moment, because you're hitting on something,
Yeah.
right? And one of the advantages of any corporation is the idea of income.
We're getting there.
Okay.
We're getting there.
Yeah.
We're getting there. I know how it works.
Okay, sounds
I
good.
want to dig into it so everyone else can kind of get into that point.
First.
Okay, can I pay for my gym membership from my corporation?
Now, that's a good question. Reasonable, because now agents, for example, you got tennis clubs, or you're doing.
I didn't ask about a tennis club.
Or just get
Gym-
that's
just
right,
gym
it's a
membership.
gym membership. Again, now it's a gym membership where you're getting your client base from.
Exactly. This is where we start.
That's where the
to get into that.
reasonability comes in. If that's what you're using to get your clients, you have got clients, you've got businesses that's been conducted with those clients. Reasonably, you can claim.
Can I take you out for dinner through my corporation?
Of course.
Of course I can. So what starts to happen, and one of the point I'm trying to get towards is, somebody says, okay, now all this money's living in this corporation. Now let's say I'm making $150,000. How does that money start to come out? You mentioned it a little bit, so let's just break it down a little slower, so they can understand how that money starts to come out of that corporation for the amount of money you need to live your life, and then what also starts to happen with the money after you need to live your life.
Exactly.
Because if you make $150,000 in a corporation and it's taxed at 12%, and now I'm only taking $50,000, so I'm personally being taxed at the lowest tax bracket, and I can live off that 50 because the other expenses in my life fall into that reasonable use. They're properly used for what I need to run my life. My tennis club and maybe my gym is where I meet clients, and my seasons tickets to the Leafs that I take my clients out to.
Yep.
Certain things like that stay in that corporation, and then you have a residual of, let's say, another $50,000 in there. So how do those two amounts of money get played, and how do we explain that to somebody?
So now, the most important thing is what kind of expenses are there.
Mhm.
So to make it easier, let's say things that are purely personal in nature, your personal expenses. You got to pay for your mortgage or your rent. You got to pay for groceries. You got to pay for clothing. You got to pay for childcare expenses. So these are expenses that are purely personal in nature, cannot be claimed under the corporation. So I can't claim it under the corporation. This is my budget. Like I've got to know how
This
much
is my living cost of life
Yes,
that I need to have this
exactly.
amount of money coming into
And
my
that's what we usually recommend with our clients. We always tell them, get a list, write down. It need not be an exact number, just ballpark it. So you yourself will know how much you need to actually pay for your personal to survive
cost
or
of living.
stipend. And that actually helps to give you a goal target at the end of the year. And of course, things that are, what you're being spending on your business. It's the same thing like what you're doing as a self-employed or sole proprietorship. For those agents who don't have a PREC, they've been keeping the list of receipts that, when you're taking your client out, etc., or you've done advertising costs, some marketing costs, etc. So the principle is the same, except now you know which goes where and which one goes to your personal. And doing so, the key is understanding how much you need to actually pay yourself. That's where you dictate yourself like a salary. Maybe it varies. Everyone is situational. Some agents might need $5,000 a month. Some might need $7,000. Some might need $10,000, depending on how much they make. So it's variable. And knowing that number, that's the key to strategic planning. It's like knowing to how to, plan ahead for your taxes. In doing so, that's why at the end of the year, you know what you already withdrew in total, what you've set it up, and you know how much to pay on the taxes for both corporate as well as personal. So you have that power, the ability to dictate how much you want to pay, the flexibility.
Perfect, and I think, and then that gets that coverage. I think now the next question that people start to ask is, okay, so now there's this residual set of money that's sitting in this company. What do I do with it? One of the things that I like personally, I like whole life insurance policies. I find that to be a corporately owned whole life insurance policy is a nice way to do things with. Gives you options. But what happens with the rest of that money? So you can only have so many expenses in a year. Maybe when I was operating as an individual, I was driving a 2010 Audi A6 hatchback, but now I'm running in this corporation. And I have all this money sitting there, and all of a sudden I'm going to go lease a brand new 2022 Audi. Same kind of situation there that's bringing down the expenses of adding expenses to this company. So what happens with the residual money? That's my end of the day. Like we now start compounding year after year, 50, 100, 200, 300. Now there's, after year 3, there's $250,000 sitting in this company. What happens now?
So that's a very good question now. It's a general concern for a lot of people. So the residual amount that's sitting in, we call it in the accounting world as retained earnings. What the company has withheld in surplus. That's extra surplus after tax. And this is where we normally tell people the buck doesn't stop with just money sitting in the account. Now, if I come up to you, Josh, and I say, like, look, I got 200,000 sitting in the bank, what do I do with the money? You would tell me invest it, of course. It's the same thing. We tell people to invest it. This is where there is going beyond the corporations. You have the ability to invest that money, of course. Let's say in the real estate perspective, you're buying properties, etc. You can invest it, and now you got. So that's the key. The whole idea is that you have a corporation. You're making your income. You're paying yourself a fixed salary, and now there's that surplus. That surplus is what you're going to use to grow your wealth, or like your personal wealth or a family wealth, something to pass that wealth down to. So that's where we talk about, like, doing investments. So let's say real estate, just how to do real estate investments, if it's additional property through corporations, how to structure them, and for tax purposes, of course. And of course, you're going to be renting it out. You got rental income, long-term, short-term, however it may be. There's taxes to also look onto it. But it's all about, like, just advising the right strategies at the right time, etc.
Right.
So
and I get that. So one of the ways that money can be used is continuing to invest within the corporation.
Yeah.
I.e., if I wanted to go buy a pre-construction condo right now, that's held in that corporation, I could use that money for that.
Yeah.
Now, what happens if I want to go and buy a cottage, and I want to use that money to buy a cottage?
So we'll structure it up using something called holding corporations, where the whole purpose of the corporation is, of course, to hold an asset. So corporations are entities, like how you and I are an entity. Entities can own assets, so corporations in this instance can own like cash and cash deposits, which means bank account, in other words. They can own properties, they can own stocks, bonds, securities, a yacht, maybe a fancy car, however you want to structure it. So you have that ability to do so, which we can definitely guide people through how to do it. And of course, we have to talk about the tax perspective on it, right? If you plan to sell them, there's capital gains, etc.
I wanted, before we go to the next topic, any questions coming in around PRECs? Anybody have any questions there? It's open floor for PREC talk. Mo, you got something to say?
Yeah,
feel it.
If there's no question, it's funny how, we're in this zone, we go out and do a bunch of lunch and learns, we go to trade shows, and we're talking about this all the time. But something you said, I think you said when we spoke to you the other day, when is the right time for a PREC? So Carlton spoke to the numbers element, but that the way you articulated, today you're making, let's say this year, 50 grand commission. It's the kind of business that overnight, tomorrow, you could be in that next tax bracket.
Yeah, one deal.
Immediately. It's not like I grew in my corporate career.
No, one deal tomorrow. You meet the right, you claim the right
So-
lead on our CRM, and all of a sudden you're
Yeah.
supposed to $4 million deal. That's that's $100,000 commission.
Yeah, and being ready matters, right? So
course.
if you're in this business to succeed, then it's just a matter of time before that. So
It's gonna happen.
maybe you got a year early or a couple of years early, but you're ready when that happens, and that's when you're going to save yourself a big amount of.
Very well said. Very well said. So segueing into our next kind of concept that we talked about is kind of tax planning, and we're kind of dabbling a little bit into that already. So and a lot of talk right now, if you're on Instagram, I don't know if you are, Carlton, or Mo, if you are. So if you watch on Instagram, a lot of talks, if you start to how the algorithm works, you start liking something on Instagram, and all of a sudden your Instagram is now starting to feed you content that you think TikTok, Instagram, same stuff. And one of the things that you hear a lot about, if you're in that space right now, is setting up a family trust, and then within the family trust having LLC, there's an operating corporation, and then within the operating corporation there's LLCs, and then those LLCs kind of move us along into how it gets divided, and it becomes this family bank because the money continues to go through, and if somebody dies it goes through, and then life insurance policies come into play. So how does that kind of fit into what you guys do, and can you speak to that a little bit, how that whole kind of model works around that, that system?
So mainly it's like how you said, the ability to set these structures up, etc. These are all within the Income Tax Act. That's why this is just about long-term planning, how to plan efficiently, following within the rules of the Income Tax Act itself. So legally, yes, you're able to set something up, plan your estate or affairs in order. So it's a very complex thing. If I go through in detail, not many people are going to be able to understand, right? But to make things simple, it's about of course, now I've done this. I've built myself an empire. I've got like, multitude of assets, etc. But I want to make sure like the transition is easy, and of course there's going to be estate taxes on it. So how do I plan ahead? This is where it comes down to the key factor. Is the major tax step that I always give, or even Mo would give, is plan early. Like you're here right now, even though there's 2.5 months till the end of the year, plan early. So it comes down to that. This is where we talk about the long term, get to know your situation better, like see what needs to be done, like how many kids you have, or who's your beneficiaries, etc. So we can advise on the terms of like, okay, look, on the tax implication, this is what the estate tax will look like, how we can efficiently reduce it, of course, again, within the Income Tax Act, right?
Mm-hmm.
So yeah.
Okay. And another question I kind of had was, like, as you dive deeper into this stuff on a personal journey, you start to realize that, like, in Canada, we're some ways like really against the wall compared to in America, especially when it comes to investment properties. I find from both a lending side of things and from an accounting side of things. And correct me if I'm wrong, but it seems like in America, you can write off your mortgage as an expense. I believe in Canada, we can only potentially use the interest portion of it.
Rates, yeah.
The interest portion of it. Now, if you're in a 7% interest only HELOC right now, as Mir and Mo, I'm sure can tell you that's what's happening out there. Does that equal out to I can write off that whole mortgage payment, that whole payment, if it's all interest?
Yes. So currently, like right now, like with a mortgage, best friend of mine just got approved for a mortgage, 6.81, pretty rough. The principal is very small, but he's only mainly paying out the mortgage. Like on his mortgage, it's mainly the interest. So yes, on your policy statement, it's going to show a breakdown of how much the total principal that you paid at the end of the year and your interest, and that interest is what we have the expense against if in case you're claiming a rental income. So you're able to write off against it. Yes.
All of it.
All of it.
100%
It's
of it.
interest itself. Yes.
Yeah. What about on your personal home mortgage? Can you write off the personal interest, the interest on that mortgage?
Unfortunately, no. See, in order to be able to write off the interest as an expense, you'll need to have an income against it. So if you're renting off, let's say, the basement in your personal home, or if it's a condo, unfortunately, or if you're subletting a room, etc., you got income coming in. That's where you have expenses to that income itself. So reasonably, you can claim a personal portion of it.
Got it. So my next question, okay, and no one's holding you to this. I'm throwing you a curveball here. You guys know Grant Cardone?
Yep.
Okay, so one of the biggest things Grant Cardone talks about all the time, and I talk about Grant Cardone all the time on my podcast, I'm a big fan of his, is depreciating your assets down to a point where you're continuously having a taxable gain every year because you're living in a deficit. You're not actually, so even if you're making all this money, your assets completely depreciated down. Is that something we can do in Canada, and how does it work?
Yes, I actually agree with what he says because there is overhead to, maintaining the property. For example, I have an additional property, I'm renting it out. Now, of course, that additional property has, my mortgage that's going on. I got property taxes to pay. I got a home insurance. Maybe some repair and maintenance work. I had to do the yard. I had to add a swimming pool or add a new garage, split the rooms, etc. Make a legal basement. So these are like actual expenses that that costed me to get this rental income. So yes, I'm allowed to actually claim it. So I think you might have heard this from a lot from your clients too. They say like, okay, look, I'm doing a rent. I want to sell this property because I'm making a profit out of rent. Sometimes advice would be like, just hang in there a bit, just bite the bullet, wait for a couple of more years till the value has come up, and that's the best time to sell. So yes, coming back to what Grant Cardone has said, I agree with it. Yes, it's in terms of the benefit, you're only renting not for profit. You're renting to just pay those overhead out. That's the main thing, right? So let it take care of itself.
So like right now, you're asking how the market's going, right?
Yeah.
When you walked in here, and we'll talk about real estate market a little bit. So, I'll talk for the condo market right now. People are having a very hard time selling their condos right now. Specifically, what we're seeing in the market right now is people who bought pre-construction condos 4 years ago, when the rates were 2.5%, 3%, they got pre-approved, whatever. That's why I always said it was bullshit that the banks were making you do that to get those approvals, because now it's at 7% and it's irrelevant. But now you go to close, and people are getting stuck closing on this condo. So they're doing what's called an assignment sale. They need to sell that condo now to get their money back out, so somebody else can close on it. But what's happening is there's so much of this option flooded in the market right now that people are taking big losses on those assignment sales. They're selling them for less than they bought them for just to get out, so they're taking a loss on it. How can somebody in that situation, in a tax world, play that hey, I might not be able to close on this, but if I get rid of this condo and take that $50K loss on the sale right now, that's going to be taxable. Like, how is that going to play into my taxes when I go to do my corporate taxes for the year if it was filed under the company?
So now, any capital asset, so let's say property, for example, when you sell it for a loss, it's called a capital loss. And losses are non-taxable. I mean, like, they can't tax you something that you lost money out of. If you've made a gain otherwise, then that's going to be taxable capital gains. So in terms of losses, no, they're not taxable. However, the loss that you made would be carried forward. So that means, let's say in the future years, you bought a property, you made a profit out of it, that loss that you took in, they're going to give you a small portion of tax relief. It'll be carried into the system, where it's going to be applied against the new capital gain that you got, and then you will pay a different tax.
So this year, I take a loss on a property that I sell of $100,000. Let's just use that number for example. And then next year, I have a gain, and I have a capital tax, a tax gain of $200,000 next year. That's my capital tax, my capital gains tax bill. I would actually only have to pay $100,000.
Yeah, out of that 150% is tax.
And how many years can that loss stay with you?
So usually capital losses are indefinite on a personal side, and even same thing with the corporation too. If a corporation has done it, they also carry the same benefit too.
Mm-hmm. Interesting. Good. I'm going a little deeper than the surface here because I know how listeners are who are listening to this kind of stuff. Next question. So now my company made $1 million this year. Okay. And now, a lot of things you hear from these guys is, okay, it's time to go buy a private jet now. I'm just throwing an example out there, but, go buy a private jet now. And now my corporate expense for the year just got bought down to $1 million because I just bought $1 million jet. How does that play into things? Does that leave you in a position where you have no retained earnings from the year and you actually have no leftover income because your expenses are really high, potentially even also becoming a loss on it because maybe I overpaid for it or whatever the situation is, or need upgrades like you said and stuff like that. So how does that play in? Because that's a lot of stuff you hear talking about.
So now it comes down to now the retained earnings scale. It's common sense really, because now let's say you've overspent, but you didn't make that income to actually match that spend. Let's say $1 million, which you spent on a private jet. Let's say it's $1.5 million. You overestimated, but you only made $1 million. Now the question is, where did that $500,000 come from? Was it your own capital out of your own pocket that you put into the company to pay that jet, etc., right?
Or maybe they gave you financing on the $500,000.
And then that's where it'll show up on your balance sheet, like where you're going to be reporting that you have a loan and you're paying an interest on that.
But you would actually be in a loss for the year through your corporation if you did something like that.
So it wouldn't be an issue like if it's a loss, Yeah.
We're just trying to play with how losses work so people can start to understand that when you start to collect this retained earning in a corporation, these guys are really good at giving you options, and there's many ways of doing it, whether that's intercompany dividends, whether that's personal dividends, whether that's whole life insurance policies, whether that's losses on properties, however it comes together. All these pieces start to play into a long-term journey as you're starting to make more money and retain more of your wealth in different ways, right? As we're coming towards the end here, I know I asked a lot of questions. What's like your top 3 tips, quick fire answers for somebody who is in a situation where they're starting to make some money and they go, obviously we talked about a few different things, but what are some things we haven't talked about that we can give people a piece of advice for? What's your main piece of advice for a real estate agent out there right now?
So planning early is important. We deliver a lot of educational sessions and whatnot. It's not your job to become, adept or a master of the tax code, right? Your job is to run your business and focus on growing your business, and leave the rest to someone else. The sooner you can do that, like every minute that you're spending thinking about your accounting and tax scenario is a minute that you're not spending on growing your business. And the ROI of that minute, if you spend it growing your business, is much higher than the cost of outsourcing some of these other areas so that you can focus. And going back to that planning early, you'll be surprised how quickly you're in that scenario where there are things that you could have done to reduce significant tax dollars. So don't leave it till the last minute, whether we're talking through the time frame of a year or we're talking about the growth of your career. Find the right partners, surround yourselves with the right partners early and let them sweat the details.
Great insight. How about you, Carlton? What's your
So I'm
go-to?
going to add a tax pointer, I guess. Just to reinforce Moe's this one. Yes, plan early. When you're starting to make it big or you're about to close, like let's say a deal and you know really big amounts coming in, call your accountant as soon as possible. They can also call us. So we'll be happy to help. We can draw out plans and tell them what it look like, etc. For the future years or for the upcoming tax year itself. The most important thing I would say is, what's the word? Always collect your receipts, your invoices, like make sure, avoid cash, like just always use a debit card or credit card, shows up on the bank statements or on the credit card statements. Sometimes easier for you, not for us to account only, but it's only easier for you to follow up to see how much your spend looks like at the end of the week or end of the month when you go through your budget. So that's what I recommend the most. But always plan early, like if in case you have a feeling or you've hit it big, you realize, okay, look, I've got this big contract, I'm gonna make this much, or estimating, contact your professional right away as soon as possible.
Well, thank you guys so much. This is great value. I'm sure a lot of our agents who are here and who aren't listening to this will listen to it afterwards, or any agent. We'll also have you guys back on November 9th for a full session so we can dive into this kind of stuff as well.
Yeah.
This is the kind of stuff we're talking about here that adds value to our agents. So thank you guys again. Thank you for anyone listening. This is Tales from the Lockbox. I'm your host, Josh Benoliel. We were joined today by White Gold Financial. They are experts in what they do. They will help you save time and money when it comes to dealing with taxes. Point blank, the end. I've been using them for about 5 years now. They get the results that you need. So White Gold Financial, hit them up today. Thank you guys for listening. As always, have a great day. Stay hungry, stay positive, stay motivated, get after it. Let's just go have a good one. Ciao.